We think the markets are coming to terms that the Fed is going to be less aggressive in lowering rates this year and probably starts a little bit later. We're not expecting any great news out of the Fed this week or any incrementally new news. We think they're going to talk about wanting to see better inflation numbers, but the idea that they will be lowering rates will happen. They're just not going to give a time frame. So we don't think anything new is going to come out of the Fed. We think if anything, it creates a little bit of a headwind for the market this week, but today the market seems to be ignoring that.
But looking further ahead, I mean, we've got a whole bunch of other central bank decisions coming up this week. Do you feel like the vibe is going to be overall more hawkish than people are expecting, or is it going to be like some signs of dovishness coming through?
We think there is going to be a balance of both of those. We think the critical thing for investors is not to get obsessed with the exceptionally near term. Understand that the Fed and the other central banks are likely going to be more dovish as the year progresses. And if you're investing today, the markets are going to discount that sooner rather than later. So we'd be looking to put your portfolio to work with the idea that the Fed is going to be lowering the rates. We're generally optimistic about stocks this year. We do expect a lot more volatility than we've seen. You had a great fourth quarter and a very good first quarter. So there's going to be some volatility. There's going to be some pullbacks. But we think ultimately stocks end the year higher than they are now, probably in the low double digits.
All right, David, given that background, what are some of the sectors you like here, assuming, I haven't been long the Magnificent Seven like Tom Keene has. What do you like sector-wise?
So basically, we think there's going to be a rotation this year with some of the things that did not do as well last year starting to do better. We think that the things that did great last year are going to slow down. You're already starting to see technology slow down some. We think that's going to continue. So we wouldn't chase last year's winners. Healthcare and financials started this year off very good after a very poor 2023. We think that's going to continue. So we think there are lots of opportunities in that area to make money on a go-forward basis. Utilities had a very poor 2023 and even a worse start to 2024. So we think that if you have a 6 to 12 month time horizon, there are lots of stocks in the utility sector that we think are going to be good investments, especially if the economy slows down a little bit later in the year and the Fed starts to lower rates. We think utilities are going to be a very good place to be. So nice place to make money with much lower risk.
Looking at the returns so far year to date in different sectors of the S&P 500, the one at the very bottom is real estate. What's your view there?
So we don't have a great conviction on real estate. We think that if rates start to go lower as we expect, it probably gives them a little bit of a tailwind. But there's so many moving parts right now with real estate. We just think they're better places to make money. So that's a sector we don't have a great conviction on. We've been negative on it for the last 18 months. I'd say we're probably neutral at this point.
David, one of the names on your list that jumps out at me is one we all know, Cisco. CSCO is the ticker symbol there. $200 billion market cap, but the stock's just kind of flat here year to date, flat over the trailing 12 months. It has certainly not, received any AI pop. What's your call on Cisco?
Well, we do think it is a second derivative AI play as more communications take place, as computers and PCs are using more mainframes in the cloud to do AI. We think Cisco is going to have to lay out more cables. You had a problem last year because there was a lot of over ordering because people weren't able to get as much as they wanted. When Cisco was able to fulfill all of their orders, a lot of those orders got canceled. So that's made a 2 or 3 quarter slowdown in their revenues. We think it's going to pick up this year. We think the worst is behind them. Stock's at 12, 13 times earnings and pays at like a 3.5% yield. So we think for investors that have a 12 to 18 month time horizon, they're going to start to catch up. We're not expecting anything spectacular, but we easily think the stock has 15 to 20% upside with very low risk.
Another name on your list, which intrigues me quite a lot, Starbucks. The stock's not been doing particularly well over the last 12 months, but what's the play there?
Double short.
So the great thing about Starbucks is they make an addictive product that generally is pretty safe for people, and in fact, in some cases, healthy for people. They've got a great footprint around the globe. The stock has done poorly in the last 6 months out of concerns that China is slowing down. China is slowing down, but China is going to start some stimulative packages in the next 3 to 6 months. And you're getting Starbucks at a great price. It pays a good yield. We like the new CEO of the company. We think the company is very well positioned for the future. Gen Z likes their products. They like the ice and coffees. So we think that they are going to be a force to be reckoned with for the long term, and you're getting it at a very good price.
David, here's a name. We had the regional banking crisis starting, a little bit more than a year ago. And I've always said, boy, I'd love to be able to kind of go into my PM if I'm at a hedge fund and say, hey, give me another couple $100 million. I'm going long regional banks. I think this is the bottom. I'm not sure we're there yet, but PNC Bank is on your list. And it's not really a regional, it's kind of like a super regional, I guess, but it's, I think, kind of grouped with some of those regional banks. Is it safe to go into some of these names, do you think?
It's safe to go into the best quality super regionals. So the banking group has had a stealth rally since May of last year. They've done really well after the pain of last March, April. But we really would want to focus on the best quality companies, best credit quality, good commercial real estate portfolios, and conservative financing. PNC meets that ticket. U.S. Bancorp, same thing. Bank of New York. We would not delve into the lower quality companies just because we don't know the risk there, and you only find out the risk or the big problems after the fact. Some of the ones that I mentioned, really good quality, very good valuations, very nice yields. We think if the Fed starts lowering rates and we don't have a recession, which we're not forecasting, these companies should do quite well.